topic examines relative value methods, which are investment strategies designed to profit from pricing discrepancies between related securities or markets. Relative value investing differs from directional trading because the primary focus is on the relationship between assets rather than predicting broad market direction. These strategies generally seek to exploit temporary mispricings while maintaining limited overall market exposure. The program emphasizes that relative value approaches depend on the existence of market inefficiencies, although these opportunities are often small, competitive, and short-lived. Investors therefore rely on leverage, diversification, quantitative analysis, and disciplined execution to generate attractive returns. Relative value strategies are widely used in hedge funds, fixed income arbitrage, statistical arbitrage, and commodity trading. The topic first discusses the foundations of relative value methods and the distinction between pure arbitrage and risk arbitrage. Pure arbitrage involves simultaneous transactions that lock in riskless profits without requiring net investment, although such opportunities are extremely rare in efficient markets. Risk arbitrage, by contrast, involves exploiting expected price convergence while accepting uncertainty regarding timing and outcome. The program explains that relative value opportunities may emerge because of liquidity imbalances, behavioral biases, information asymmetry, or institutional constraints. However, limits to arbitrage often prevent immediate correction of pricing discrepancies. These limits include transaction costs, leverage constraints, model risk, funding risk, and the possibility that apparent mispricings reflect structural market changes rather than temporary inefficiencies. Pairs trading is one of the most common relative value strategies examined in the program. Pairs trading involves identifying two historically related securities and taking offsetting long and short positions when their price relationship diverges from historical norms. Investors expect the spread between the assets to eventually revert toward equilibrium, generating profits from convergence. The topic outlines several key steps, including selecting related securities, measuring historical relationships, defining entry and exit signals, and managing position risk. Pairs trading strategies are often market neutral because gains depend more on relative price movements than overall market direction. Successful implementation requires disciplined statistical analysis, careful risk management, and ongoing monitoring of correlation stability and structural market changes. The program also explores statistical pairs trading and the use of quantitative methods such as cointegration analysis. Cointegration identifies securities whose prices move together over time despite short-term deviations. Statistical arbitrage managers use mathematical models, regression analysis, and historical data to identify convergence opportunities across large portfolios of securities. The topic emphasizes that timing is critical because convergence may occur unpredictably or fail entirely if underlying economic relationships change. Statistical pairs trading can involve equities, commodities, fixed income securities, or currencies. Risks include liquidity shortages, transaction costs, leverage exposure, model failure, and breakdowns in historical correlations. Consequently, quantitative relative value strategies require sophisticated technology, strong operational controls, and continuous recalibration of statistical models. Pairs trading applications in commodity, fixed income, and currency markets are another major focus of the topic. Commodity relative value strategies often use calendar spreads, quality spreads, location spreads, and processing spreads to exploit pricing relationships between futures contracts or related commodities. Fixed income relative value strategies may involve yield curve trades, duration spreads, or credit spread positioning based on expectations regarding interest rate movements and convergence relationships. Currency relative value trading frequently incorporates carry trades and covered interest rate parity analysis. The program explains that these strategies rely heavily on understanding macroeconomic relationships, storage costs, financing conditions, and market structure. Because spreads can widen unexpectedly during crises, leverage and liquidity management remain essential considerations for relative value investors. The topic concludes by examining relative value market-neutral strategies and their associated risks. Market-neutral investing seeks to minimize systematic market exposure while generating returns from security selection and spread convergence. Equity market-neutral strategies commonly balance long and short positions to reduce sensitivity to broad market movements. However, the program stresses that market neutrality does not eliminate risk entirely. Relative value strategies remain vulnerable to liquidity shocks, funding pressures, widening spreads, correlation breakdowns, and leverage amplification during stressed market environments. Fundamental risk may also arise if economic conditions justify persistent price divergence rather than convergence. Effective relative value investing, therefore, requires careful portfolio construction, robust risk controls, diversification across positions, and continuous monitoring of market relationships and liquidity conditions.